in an ideal world, gold should have parity with government bonds and should be used equally in the same way as government bonds are today in terms of high quality liquid asset or liquidity coverage ratio requirement. And I think we've proved using the data that we've got and using some analytical data produced by an academic that gold really is not a barbarous relic at all. It's a high quality liquid asset.
Welcome to Smarter Markets, a weekly podcast featuring the icons and entrepreneurs of technology, commodities, and finance, ranting on the inadequacies of our systems and riffing on ideas for how to solve them. Together, we examine the questions: are we facing a crisis of information or a crisis of trust? And will building smarter markets be the antidote? This episode is brought to you in part by Abaxx Exchange, where trading in centrally cleared, physically deliverable LNG and carbon futures contracts is now underway. Ready for smarter markets?
Welcome to Gold for the 21st Century on Smarter Markets. I'm Dave Greely, Chief Economist at Abaxx Technologies. Our guest today is David Gornall, Strategic Advisor for Precious Metals at Abaxx Exchange, former Global Head of Precious Metals Trading at Natixis, and a former Chairman of the LBMA. We'll be discussing where gold market infrastructure is not keeping pace with the evolving use of gold, what it means for regional price discovery and trading, and what market infrastructure and regulatory changes are needed to allow gold to take its seat at the financial table and meet the demand for gold in the 21st century. Hello, David. Welcome back to Smarter Markets.
Thanks very much, Dave.
Well, it's great to have you back here on the podcast, and a very good time for this particular conversation on gold. I was thinking back, and while John Maynard Keynes once famously called gold the barbarous relic, today sanctions, tariffs, and the rising potential for a trade war are leading to a renewed questioning of the global financial system's reliance on the US dollar, and leading to a renewed interest in gold, which has recently crossed the $3,000 an ounce price mark. So I thought maybe I'd start off with a big question for you, David, which is, what do you believe the role of gold should be in our financial system in the 21st century?
Well, that's for somebody else to decide, but I think you've already started to see what that role could look like. I saw a really interesting graph this morning, which I think I've got to give credit to, which is Alfonso Pecotillo. It's a very simple chart, speaks for itself, but it shows the central bank reserves in euros remaining fairly constant. And in the last 6 months, the central bank reserves in dollars decreasing by the same amount. The central bank reserves in those countries have increased their gold holdings. I don't say the same amount, but a very similar amount. So I think that the role of gold in the future is already looking to change. There seems to be some sort of paradigm shift in certainly the way the central bank reserve managers look at it. You mentioned John Maynard Keynes famously was the UK rep at Bretton Woods, who didn't actually get his way. I think was it Bancor he was trying to advocate. So I think those words have gone full circle now. That Harry Eichengreen, I think, recently wrote a paper on gold and said, "A barbarous relic, no more." And I think we'd probably all like to agree with that. So I think the central bank activity is by far the most important new shift in gold's new role.
And, when you think about, it sounds like gold, the future of gold may look a little bit more like its past with having such a role. You kind of mentioned Bretton Woods and kind of central banks now looking to have more gold reserves. How much do you think the future of gold might take its lead from the way gold is currently being used in Asia?
Asia's a little bit behind the curve at the moment. It's a lot of press because of the amount of demand and activity we see. And just looking this morning at queues in gold shops in Vietnam, where the sale of gold is restricted to a very limited amount per person. So I think they're just starting their journey from a central bank perspective. The Western world has, 2/3 of central bank gold reserves, and the eastern part of the globe tends to be quite small by comparison. So we've always said that's got a long way to go, China being the biggest in terms of growth in gold within their central bank reserves. So we've always expected that to realign. with the Western world remaining fairly passive in its holdings, with the exception of a couple of European countries. Like Poland has been quite active recently, and Serbia and the Czech Republic. It tends more to be on the eastern side where those gold reserves are growing. So we would kind of expect that to carry on.
And how do you think about that contrast between kind of what the person on the street is holding gold and much of the physical trade is in Asia? But then, as you said, when you look at the central banks in Europe, in the US, much of the gold is being held in central banks, and that's been increasing recently, central bank holdings. How do you think about what the increasing holding of gold by central banks means, and how do you think about it compared to the use of it by the person on the street?
They say that the United States is the biggest holder, but privately, the man on the street in India would probably be a strong challenger to that. I think some people say it holds 3 times as much gold as the United States does. So I don't think that the message has been lost on the man in the street either. I think there's a fair amount of FOMO going on now. Gold keeps making new highs, and it doesn't seem to be affected by any negative reason. But with the support of the central banks, it does look like gold is becoming a lot more mainstream, which is quite interesting.
And if you look around, I mean, you've been in the gold market a long time. You've been a former chairman of the LBMA, ran gold desks. When you look at how the gold market's structured and operates today, what do you think needs to be fixed or sorted out in terms of how the market's structured to allow it to take on a greater role in the financial system to meet the needs of, say, the man on the street and the central banks?
The man on the street could certainly do with access to greater amounts of capital. I'm talking about more in the business sense and in the growth sense. And as we all know, a lot of that capital is held as a contingency by banks for various purposes post GFC in 2008 and all the other Basel regulations that have come in since then, and notably the liquidity coverage ratio. So I think that the market, the way it sits at the moment, is not very well understood. Central bankers don't really like the idea currently of having gold included as an asset class that is categorized in the same way as a government bond, as a high quality liquid asset. Part of the reason for that is the way the market is structured, with a futures market in the US, with an OTC market in London, with 2 different types of bar, a lot of attention obviously over the dislocation of the price and the bifurcation of the market in not just London and New York, but in India as well. And as I mentioned, Vietnam. So it has a lot of questions to answer in terms of how do you settle? How do you access the market? Who can access the market? I think that's what we really need to address, because having an OTC market in London, which is dominated by a 400-ounce bar, and a futures market that is 100 ounces or 3 kilobars, is always going to be dislocated when US buyers are present on the futures exchange. They started buying it because of the Trump tariff threats, but they'll carry on buying it if they believe that the gold price is going up, because they've got access to the futures market. They're looking for the leverage bet. They don't want to hold local London. So the way I see this now is that all of the occasions that we see gold rally, gold tends to be at a premium to London, and that will carry on. Why is that a problem? It's a problem because the holders of physical gold are finding it harder to hedge on futures because of the margin calls that are going against them, that are potentially unlimited. How do you finance that as a bank, as a treasury? It's very difficult. And the risk limits that are now coming in place because of these dislocations are also going to reduce the amount that banks can hedge in a futures market. So a lot of people have been talking about having a market that would be co-located and have the OTC market sitting alongside the futures market in the same location, in the same format. That would alleviate a lot of these problems. But I think to expand this out a little bit on the rest of its usability, if you like, we were going to talk about the collateral side of the business. I think that not all things are suitable for every type of market. So there isn't really a magic wand that says we need to change everything to look like this, because clearly ETF works for gold. ETFs work for those that can only hold equities and not commodities. So that part of the market, or an ecosystem that sits on its own and supports itself. But what about the collateral side of the market? How do collateral agents take gold as a collateral? Would they have to take it physically? Could they take it as a warrant? How would that operate? Is there a depository that is common to all of them? None of that is clear today. And one suggestion that's been put forward is maybe a digitized version of the physical gold is used within the collateral services that are provided by the collateral agents today. Because that tends to be the competition, if you like, for gold use.
I'd love to dig into that some more because I think it's so interesting. And many of the conversations you hear are around the use of gold as money, that it's a competitor to the US dollar. But, when you think about gold as collateral, it's really more gold as a competitor or a substitute for US treasuries for use in collateral. Could you dive into why being able to use gold as collateral, why would it be so important? What would that improve and who would it improve things for?
It should improve. If it's going to work, it has to improve things for everyone. The definition of collateral is broadly a government bond. Primary use is to manage debt management for various jurisdictions and monetary policy. It's used within the LCR for liquidity purposes, and it's used for collateral. So there's a lot of competition for a single asset class, such as a bond. So it might not be an issue today, and it might not be an issue in the United States or the United Kingdom, but in countries where there is a shortage of bonds, I think that there could be a benefit in having gold included. If we're all going to use the same collateral, then there's a huge demand for that collateral, but it's one-sided. So I think the difficulty for most of these collateral agents is that they don't really get to choose gold. It's not something that's easy for them to see.
And with gold, I guess the biggest impediment for the use of gold as collateral is regulatory. What needs to change on the regulatory side to enable wider use, and why do you think that's a good idea?
There are restrictions on the use of collateral in legal terms. As we all know, we can use it within a clearinghouse situation where we can use gold with a 20% haircut or so to pledge against a margin. But legally, what needs to change from the liquidity perspective is for gold to be included as a high quality liquid asset. I would say that that's the main challenge for gold in the near future.
And when you look around, I think the gold market's obviously getting a lot more attention these days, price going above $3,000 an ounce, the dislocations between the price of gold in New York and the price of London, people looking at the large amount of gold flowing into the United States recently. What do you make of the situation that we're in now? How would you describe it?
Some would say that the premium in the States is justified by the buyers. They're certainly happy to carry on buying it. And if it does get dislocated, then that's a normal market function. We often have in other markets premiums and discounts within the same year. And it's not unusual in places like India or China to see that. So why should it be any different in the US? I don't think that it's such an uncommon thing, I would say.
Given the market structure, you'd expect the price in New York and the price in London to vary for different reasons over time. But the fact that we're reliant on needing the futures in New York to converge into the spot in London is what makes it problematic.
It makes it problematic, but mainly because the buyers tend to use the leverage market. So the buyers are always going to go and buy the board. They're always going to buy COMEX. They're not going to buy London. So we've always had a little premium over London because of that. In an extreme market such as this, where we've seen prices move as we have done, this continued buying is exacerbating the situation. And they don't really care that they have to roll that gold forward twice the cost of money. The fact that they have access to the market is good enough. They're riding the price rally and they're making money out of it. So why should they be worried if they're carrying the cost is at 9% to roll it into the next month? It's not really an issue for them. So this is why we don't really see it being an extraordinary event from that perspective.
And you've brought up the concept of access a few times where, the futures market in New York, it's where you can get leverage. It's also relatively straightforward to access. The London market's always been more challenging to access. Maybe that's the way to put it. How do you think about the issue of access and the impact it's having on the gold market today?
Well, I think access has always been driven by just the KYC and AML, but from various credit considerations. And so you're going to have to be a certain type of customer and a certain size of customer to be able to access that pool. Otherwise, you're going to have to find a derivative or an exchange that suits your ability to trade. So you get the natural breaks, you get the arbitrage happen because of those reasons, because certain people access one side of it and they can't access the other. So it's another reason why it's probably a better idea to have a much wider pool of spot access that sits alongside a futures exchange. And I think that we've already seen examples of this in India. IIBX has a dollar spot market, if you like, which you can access. You can settle T0, it's a pre-funded dollars or gold requirement, and you're in. You don't need an intermediary. And if you want to hedge futures, you can hedge futures there as well, although that's not normally preference for the Indian users. But I think that's probably the way to think about the market going forward. The ability to access the spot market is something that's needed.
So you brought up greater access, co-location of futures and spot. You've also brought up this idea that different size bars are used in different places. And I think many people who aren't deeply into the gold market don't really think about that. So can you talk about which bars are used in different regions and why that matters?
Why it matters and historically, why has it come to be? So, well, London, as we've spoken about, has a 400-ounce bar for approximately 12.5 kilos, and that's been there for historic purposes. It hasn't changed. And if you're warehousing gold and you're moving it around, it's a lot easier to count 400-ounce bar than 12.5 individual kilo bars. So, from a logistics point of view, and also for the fact that London is more of a deep storage market, the bars at the Bank of England sit there, and some of them have sat there for many decades, don't tend to move unless you've got a situation like we have at the moment. But the historical reason is that London likes the 400-ounce bar because it suits its market, whereas the jewellery markets in Asia rely on either a 295 or a 49s kilo bar, depending on what jewellery they're making. And it's a lot easier to move around in single bars. So again, for logistic reasons, that's going to be historically the bar of choice. And it's interesting that the futures exchange, it does have a 400-ounce contract, which has never really been used in COMEX, has kilobar delivery, and it has a 100-ounce. But all the liquidity is in the smaller size. So I think that the London OTC market is the standout outlier for the rest of the markets of the world.
And it's interesting because the more we talk, the idea that comes to my mind is if you look at the gold market infrastructure that we're accustomed to, centered around London, also New York, it seems to be a market that's really set up to meet the needs of large banks and central banks, whether it's the size of the gold bar, the ability to access the market. Whereas when we look to Asia, it seems much more focused on retail, might be the wrong word, but the smaller customer, using smaller bars, needing greater access for greater numbers of people. If you think about the market of the future, the markets that we should be adjusting our market infrastructure to meet the needs of, do you think it's this large bank, central bank model, or more democratized, more openly accessible, smaller holder model?
Well, I think it's going to have to be both because the central banks have built their reserves in large bars. So I don't think it's a secret that the People's Bank of China hold large bars, even though their local market trades in kilobars. And there's a reason for that because the international group of central banks have all chosen the 400-ounce bar. And that's never going to happen in the case of an Indian jewellery market or investment market. So I think we'll always have different size bars, and we do in lots of different commodities, and in energy products we have lots of different grades and lots of different standards for different locations. I think that that's always the case. What we really need to do is to provide some light and some liquidity on how to trade that. So if there is a central limit order book somewhere that has access to the large bar and the kilo bar, then you start to unravel the difference and you create liquidity in switching those at premiums and locations. And I think when that happens, then you tend to tie the two together.
Can you give me an example of what that would look like? what that's unraveling?
If somebody in Singapore was trading kilobars, they're looking not at price discovery in Singapore, they're looking at price discovery in London. And if they're looking at price discovery in London, most of the time the supplier of the price and the product is going to be hedging that on COMEX. So you can see straight away that you've got a futures price driving a spot London price that's driving a local Singapore price. And to find out all of those differentials isn't that easy. It's not that immediately apparent. And it could probably do with some more transparency to allow that market to flourish a little bit more and a little bit easier. Too much friction, I would say.
Well, maybe that's a good jumping off point because, on Smarter Markets, we do like to encourage ranting about problems in our markets and riffing on ideas to solve them, as we say. So, what I was curious, given, your time in the gold market and your experience, I was curious, what are the leading market issues that you would want to rant about? And then maybe we can riff about some of the ideas to solve them.
Well, I suppose it's the same rant that everybody else makes. Why do we have to keep paying these margin calls? And why do we have position limits on front months on COMEX? Why do we stop the flow of material into a market that's clearly demanding it? Whether it needs it or not is a different matter. The deliveries into COMEX are continuing now. So I think that those margin calls, those problems are not going to go away. If you had a market that had a spot market within the same warehouse as a futures market, you wouldn't have those margin calls potentially, would you? So if you were sitting with physical stock in a spot market in a location such as Singapore, and you had to hedge short in a Singapore futures contract, then you should be able to pledge that gold against your short and therefore eradicate the need for initial margin and eradicate the need for variation margin. And where else does that go? Member default funds, they're going to look a little bit different. So I think that could be an improvement for capital, for the use of funds, the margin requirement. You could boil that down and stop moaning about all these margin calls that you've got pestering your treasurer for, that he's not really too pleased about handing over because he doesn't really know how far the margin call stretches to. He knows it's probably going to run off at the end of the month, but he doesn't know to what extent he needs to fund it. So I think that's the main rant of the market.
I'm curious, you talked a little bit about the perspective in your example of someone sitting in Asia in Singapore. When we look at the dislocations between New York and London, how does that affect trading in Asia beyond making it harder to know exactly what the price is?
Well, it's not just finding out the price, it's actually finding the commodity. The Asian buyer is looking for the underlying. He's not looking for the future side of it. So how's he going to do that when he's used to pricing in $1 or $3 premium for his kilobar? If they're all going to New York at $10 over, he's going to have to pay $10 or more. So I think this is the other issue that he's got because of this dislocation. He ends up suffering too, and he doesn't technically have any connection with it. As I described, because of the reliance on Singapore to price via London and London via New York, the whole pricing mechanism becomes contagious, if you like. What happens in New York then transfers to Singapore. So everybody has to adjust to everybody else's problem.
And you've also been a gold trader, precious metals trader. Obviously, a market that's making new highs and moving up attracts attention and attracts new traders. I'm curious, do you have any advice for people getting into the gold market today?
Talk to as many people as possible, I would say. There seems to be more advice out there than ever before. I've never seen so many posts on LinkedIn about gold as I have today. And I think for anybody that's getting into it, it's quite rare to have all this information in front of you. So whether it's, it's open interest, it's margin rates, it's trade flows. I mean, the LBMA trade data didn't exist 7 years ago. So you can now look into that and start to see the depth of the market there in terms of bid offer spread, in terms of daily volume, option strikes, the amount of swaps that are traded. So there's an awful lot more liquidity out there than there was when a lot of these banks came to the market 20, 25 years ago. And there's a lot more information as well. The advice is to do a widespread trawl of the market to see what data can support your business, because I think you'll be surprised. It's not as opaque as it used to be.
And when you look at who's trading gold now relative to, say, 10 or 20 years ago, in terms of the types of participants, has that changed, whether it's, large bank trading desks or hedge funds?
Massively. I mean, when I was trading, it was most banks were all things to all men. Every product, every position. I suppose that the best manifestation of that is looking at the members of the gold auction. So you remember the old gold fix and it had 5 banks on it. Now there's, I think, 15 participants, and the majority of those are non-banks now. So I'd say, yeah, banks are taking less risk, can afford less risk, and that slack is being taken up by trading firms and non-banks, generally speaking.
It's interesting. It sounds like the banks have pulled back, non-banks have moved in. Is that another manifestation of, the risk weighing of gold that banks have to deal with?
This is a common misconception as well, so we might as well clear this up while we're having the chat. The risk weighting of gold within the capital rules of Basel 1, 2, and 3 have not changed. So the tier 1 capital that is part of the bank's capital is 0 rated if it's gold in your own vault. And that has not changed. What has changed are other regulations, such as the net stable funding requirement, which requires banks to basically double fund the gold. So if they take a gold deposit on their books, they put it on their balance sheet, they have to put and borrow HQLA against that. In other words, they've got to borrow cash or bonds. That makes it much more expensive for a bank than a non-bank. I think that's clearly a problem. I don't think that the banks have moved out of the forwards and swaps and it's been taken over by the non-banks yet because of the sheer size of the market. But I think it's something that the non-banks do have a slight advantage with.
Well, David, I know we started off asking you what the role of gold in the 21st century should be. Maybe that was the wrong question. So as we wrap up, I guess, are there some things about what would you like the role of gold to be going forward? How would you like to see it being treated within the financial system and how people think about it?
If you look at, there's a recent publication on SSRN saying, is gold a high quality liquid asset? I think it answers a lot of those questions because gold is equal in almost every terms to a government bond in its liquidity metrics. And that is the main consideration for being on the high quality liquid asset list. If that is the same, then in an ideal world, gold should have parity with government bonds and should be used equally in the same way as government bonds are today in terms of the high quality liquid asset or the liquidity coverage ratio requirement, and also the collateral arrangements we spoke about earlier. Gold's place at the table, if you like, is definitely up there alongside government bonds. It shouldn't be sitting there alongside lots of other commodities that we won't mention because it might be insulting to do so. But a lot of other commodities also require 85% net stable funding requirement, and gold really shouldn't be there. And I think we've proved using the data that we've got and using some analytical data produced by an academic that gold really is not a barbarous relic at all. It's a high quality liquid asset.
Thanks again to David Gornall, Strategic Advisor for Precious Metals at Abaxx Exchange, former Global Head of Precious Metals Trading at Natixis, and a former Chairman of the LBMA. We hope you enjoyed the episode. We'll be back next week with another episode of Gold for the 21st Century. We hope you'll join us.
This episode was brought to you in part by Abaxx Exchange, where trading in centrally cleared, physically deliverable LNG and carbon futures contracts is now underway. Ready for smarter markets? Contact us at onboarding@abaxx.exchange. That concludes this week's episode of Smarter Markets by Abaxx. For episode transcripts and additional episode information, including research, editorial, and video content, please visit smartermarkets.media. Please help more people discover the podcast by leaving a review on Apple Podcast, Spotify, YouTube, or your favorite podcast platform. Smarter Markets is presented for informational and entertainment purposes only. The information presented on Smarter Markets should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on Smarter Markets are those of the participants and do not necessarily reflect those of the show's hosts or producer. Smarter Markets, its hosts, guests, employees, and producer, Abaxx Technologies, shall not be held liable for losses resulting from investment decisions based on informational viewpoints presented on Smarter Markets. Thank you for listening, and please join us again next week.